Hello again and welcome if you just joined us to the second session of the day. We are still in Asia, this time with Pruksa Iamthongthong, who runs the trust along with co-manager Adrian Lim. Sorry, I should introduce the trust, didn't I, before I tell you she runs it. It's Asia Dragon. Asia Dragon has a broader remit than its sister trust that we just heard from, investing in China, but also across the Asian continent, with big holdings in Taiwan, India, Korea, and Hong Kong. The trust pursues a quality-driven approach, aiming to be a cornerstone investment in Asian equities. I'll hand you over now to Pruksa, so she can tell you all about how that works in practice. But before I do, please do make use of the Q&A function on your screen, so you can gain access to the manager and take advantage of that. Cheers. Pruksa, over to you.
Okay, thanks, Pascal. Good morning, everyone. Let me try to get the controls right. So thank you very much for your time today. Hoping to speak for about 20 to 30 minutes, and then we can leave plenty of time for Q&A, given that this is such a volatile market for the last 2 to 3 weeks. So just a few words about Asia Dragon. As what Pascal mentioned, we capture growth from world-class Asian companies. This trust is co-managed by Adrian Lim and myself, and we are part of the broader Asian equities team based in Singapore. If you look at the trust, it is one of the largest trusts out there. Small dividend yield, so that's not our objective here for the trust, and our gearing is at about 8.7%. 3 things in terms of characteristics for the trust. We are leading in the sense that we look for leading companies that will outperform over time. We are long-term, and we take a long-term view when we think about our investment horizon, and we are local. You will see later on is that we do have a large team on the ground to help us to really do the due diligence to the debt that we do, and that has allowed us to have the local insights. So how are we different? This would give you a snapshot in terms of the key characteristics of trust. We have been investing in Asia for 30 years, so we definitely have a long heritage, seen many cycles in the market as a team, and a large footprint on the ground in Asia. So we have 40 strong team members, including myself, within Asia, and we do have a dedicated ESG specialist sitting with us in Singapore as well that helps with ESG engagement, and we can talk a bit more about that later. In terms of performance, we do have a strong track record for the trust. You'll see that the middle box is all about ESG, and ESG is the center of what we do. So we talk about true ESG integration that is part of our process, and we drive engagement for a positive outcome. In addition to that, we have a central ESG team which sits in Edinburgh, and basically they are the specialists that are on top of all the most topical ESG issues that we need to take it and engage with the companies on the ground. And the trust and the company is also highly rated for ESG. In terms of what the trust stands for, we have 6 key investment themes for the trust, and we are positioned for long-term structural growth in Asia. In terms of culture, we are team-based, flat structure, and this is a high conviction trust where we and pick the best stocks of 50 to 70 stocks that we believe are the highest quality in Asia to drive the long-term returns. So the agenda today would just give you a quick portfolio update, tell you a bit more about our approach to ESG, and we can give a bit about how we are seeing the future going forward. Sorry, having issues with the
So would you like to try turning off your camera? If it helps with bandwidth. Ladies and gents, just bear with us and we'll just resolve this technical glitch. We'll be back shortly.
line with the market overall. On a one-year basis, we are more resilient than the market, and long-term performance has been strong. And just going through quick contributors for 2021, where we have been more resilient than the market as a whole. So you will see that in 2021, key countries that have contributed to relative performance would be in China. And within this is really a function of us being underweight to China and underweight to the China internet sector, which has been going through a tough time over the course of the second half of last year, and being having more exposure to what we feel are the new going green themes. So you see, for example, to the top right-hand corner there, Yunnan Energy, they do battery separators, so very much all part of the EV value chain. The other one that did well was a company called Nari Technology, and this is the one that does your smart grid automation. And the thinking behind this is really as China shifts towards more renewable energy, you would actually need to upgrade the grid system, and this is the company that does that. Apart from China, the other country that did well for us was our non-benchmark exposure to Vietnam. So our companies there, such as Techcombank, has done quite well for us over the course of last year, and follow that would be Singapore. In terms of where things have detracted a bit would be in India, and within India, it would be a combination of us holding banks that have not rallied as much as the rest of other banks within India. This is largely driven by liquidity reasons, where last year India has an exuberant year in terms of market performance, and those higher quality names tend to have lower beta. The other one that did not do well for us would be our position in Taiwan as well. If you look at the sector attribution, this is quite interesting. So healthcare is a contributing sector for us, and within that, we did particularly well in stock selection, where our names have been more resilient than the overall healthcare sector, which have sold off for more than 20% over the course of last year. And then in terms of consumer discretionary, our underweight there help. This is where the Chinese internet companies are classified. And this as a sector has fallen about 28% last year, and has a very volatile year this year. Consumer staples have done well for us. Here is largely stock selection. So our Chinese companies here, such as Cha-Cha, which sell things like nuts, for example, have done well, and Moutai, which is a premium liquor company, has done pretty well, being more resilient in the market. On the other hand, sectors that have caused us would be in terms of financials. So this is very much some of the banks that we hold in India, as well as the insurance company, and that has a tough year last year. Moving on to show you the top 10 holding of the trusts, you will see that you'll see that these are long-term holdings that we have within the Asia Dragon Trust and within Aberdeen as well, are very much a testament to our long-term investment horizon. And it's a good mix of companies, where it's a mixture of technology companies, it's a mixture of digitalization theme, it's a mixture of housing and mortgage companies within India, as well as some of the financials within Indonesia and Singapore. So if you look at the top 10 names, this makes up about 47% of the trust. So very much a high conviction portfolio that you have here. So just a few words about what we have been doing over the course of 2021. You can see that we have been a pretty active year, and it has been a very active market as well. So what we've been doing over the course of last year is a few things. Number one, we have been reducing a bit of China, and within that, we basically try to diversify a bit more from China Internet into growth names elsewhere across the region. So that led to the introduction of companies like Kakao, for example, which is the internet platform in Korea, as well as C, which is basically your e-commerce play within Indonesia. And then I think as opportunities within India start to emerge, when these tech companies have come to the market last year, we have taken part in some of that as well. So apart from diversifying away from China, other things that we have done within China is to add more to domestic China. So this is where we feel that structural growth continues to be very strong. And within that, we have focused on adding names that are very much aligned to the 6 long-term structural themes, which we will identify later on. But they will tend to be in the form of digitalization, for example. So one name that we have introduced is a company called Yongyo. This is a ERP software company, so very much playing on the increasing penetration of digitalization in China. It will include names like Sungrow, which basically they do a combination of solar inverters as well as energy storage systems, again, part of the green transition within China. We have also added a few value names. One of them is a bank in Thailand called Kasikorn Bank, and this is on expectation of number one, reopening of ASEAN economies as vaccination starts to improve within ASEAN, and number two is really on rising interest rates that we are expecting to come through in the earlier part of the year. On the flip side, where we have been reducing apart from China is that we have actually been exiting some of the names that we have felt that they were lower conviction on a relative basis. So one of the names is Ping An Insurance. That's where we have exited during the year, and we have also tidied up a property holding within Hong Kong as well. This slide would give you a quick snapshot of the country allocation for Asia Dragon Trust. So you would see to the graph on the right-hand side, Vietnam is our largest relative country position, our non-benchmark exposure, and this is followed by Singapore and Philippines and Indonesia. In terms of countries where we are underweight, they tend to be a bit more in North Asia. So that's a combination of Korea, China, as well as Taiwan. Moving on to the sector allocation, in terms of key relative exposure, then you will see that financials is one of our largest overweight. This is something that we have been adding to over the course of last year, a combination of adding to the bank holdings that we have across the region, as well as the Singapore banks, which we deem to be more rate sensitive. And within that, we have also changed the mix of insurance companies a bit, where we basically increase our weight within AIA, as well as reduce our holdings in Ping An Insurance for relative quality reasons. Apart from that, the next one that we have exposure to would be information technology. And this would be a mixture of software and IT services companies. One of them that has been a core holding is Tata Consultancy Services. So this is an IT outsourcing company in India that very much helped to digitalize and transform the needs of enterprises around the world. We also have semiconductor companies within this portfolio as well. We continue to see this as long-term structural growth areas, and we do have the digitalization/localization software angle in China. On the flip side, if you look at where we have relatively lower exposure versus benchmark, that would be in consumer discretionary, and that would very much represents our underweight to China Internet. And we have underweight position in utilities and energy as well. So the next section, I'll just like to spend a few minutes to talk to you with regard to our approach to ESG. You will see that responsible investing and ESG has been something that we have been doing for a very long time. We talk about our long heritage in Asia, so this is something that we have been adopting in our investment process for more than 30 years. But I think more recently it has become a lot more in terms of the focus, and the framework has also been a lot more set today, given where the importance of ESG is heading as well. So just a few words about our quality investment process, and I think this has become even more important during the current volatile time, where I believe that making sure that we select a quality company that would be able to use this volatile period to either become more resilient or they expand their business is something that we have been trying to do in volatile time, which is to tighten the quality of the portfolio. And what we mean by the quality, there's a few angles to this. Apart from strong management team, because we believe that management team drives the strategy of the company, we like companies with strong financials as well. So if you think that the world is going to go through a very tough time, the ability of the companies to survive in terms of rising interest rate environment as well is important, and that needs to be backed by strong financials. And then ultimately, we would want to invest in companies that have a strong competitive advantage. And I think especially in emerging markets, whether you look at China or you look at India, if an industry margins are very high, many players would like to jump in. And if a company doesn't have a strong barrier to entry, then the margins do get competed away with time as well. So ascertaining this has been one of the key debates that we do when we have team discussions. And you will see here that ESG is something that we view as part of the overall quality assessment criteria. And this ties very much in the way that the company deals with their ESG risks and how they actually turn this into opportunities, because we believe that ESG is also a financial cost to the company and does impact the sustainability of the company over the long run. So how is our ESG approach different? I would say that the key thing is that we do pride ourselves in having our internal capability to do this, very much similar to the due diligence that we do ourselves on the ground when we visit companies. We actually do the same with ESG. And this is extremely important in Asia because information disclosure is really poor by companies, but that doesn't mean that they are not doing the right things or they are not doing the right standards. It's just that they are not disclosing what they do, and they actually don't know what to disclose as well, given that this is something pretty new in Asia. So this is where we come in to understand and make a real assessment internally on what is the true capabilities of ESG from this company's perspective. We give them an internal ESGQ rating, and that form the basis for our engagement with the companies. We then cross-check this with external providers, and generally what we find is that our companies tend to have better rating internally versus external providers, and that's really because external providers, they actually do based on information disclosure, so there is a bit of a lag there in terms of getting them to recognize the true quality of some of these companies. And we're able to do this because fund managers do go and talk to the companies themselves, go and talk to the CEO and the decision makers, and the knowledge from this is then in terms of what to gauge for a particular company in a particular sector is filtered down from the top, where the 20+ experienced ESG specialists do give a guidance as to, okay, if you are talking about a semiconductor company, actually water and sustainability of water is something that is material within this sector. And that's really because for things like advanced semiconductor manufacturing, you do need plenty of ultra pure water, for example. So I think the materiality of topics that you talk to companies about would really depend on what sector they are in and depend on how the company within that sector is not a one size fits all. So this talks about our internal ESG research. And these slides basically shows you how what I talked about just now about how we actually rate quite differently from external providers such as MSCI. So we are the light blue bar there, and essentially what we try to do is we try to engage with both the companies as well as MSCI to drive the improve in ratings of our companies. So I'm pleased to share that over the course of 2021, we have a net of 7 upgrades that we see in terms of MSCI ratings that have come through, partially driven by our engagement efforts and improved disclosures from the company. And the last slide that I would like to show you on ESG would be the overall MSCI rating for the portfolio, where from a score basis, we are rated the same as the benchmark in terms of A. From a numerical basis, where it breaks down the A letter down, we are better than the benchmark by about 5%, and we score better on all metrics, including environmental, social, and governance metrics. You will see from this table on the bottom right-hand side that carbon intensity of the portfolio is about 38% less than the benchmark. And the top right-hand corner would show you what we call our climate change tool. So basically, we have a tool that allows us to run a scenario out into 2050, where we use a probability weighted scenario. And what that means is that you will see a valuation uplift of about 2% in the portfolio versus 0.3% in the benchmark. And therefore, this portfolio will actually be pretty resilient and even more beneficial when you have a tighter climate change scenario that comes through. Now, I'd like to spend the last few minutes just to breeze you through how we see the future. Given how fast things have moved, some of these slides would be less relevant today, but I'll touch on 4 key topics. The first one would be COVID. So in terms of COVID, I think the key takeaway from here is that Omicron, at the beginning of the year, we were quite afraid that it will cloud our recovery outlook, particularly among ASEAN economies that are reopening. But I think, fortunately, despite the higher transmissible variant, it hasn't resulted in an overload of the healthcare system. And I think many countries within Asia, including Thailand, are starting to move towards leaving the endemic as well. We are in that current phase in Singapore at the moment, and that's really because it's not overloading the healthcare system and causing a lot of death within the hospitals. So the key takeaway here is that Omicron has not really delayed the reopening of ASEAN economies in a significant way, and we continue to see the pace happening going forward as well. The second part is about rates tightening, and now we perhaps have seen from the start of the year where growth to value rotation has been really strong, and this is very much driven by a faster than expected pace of the tightening from the Fed. And I think this is on the back of how inflation seemed to be less transitory than initially indicated, and we are seeing that pressure across US and Europe in more developed markets. Asia so far, inflation has continued to be relatively under control. You will see that apart from India, in many parts of Asian economies, inflation has not been that of a significant issue. The focus for central banks have been a lot more on reopening the economy. But I think what has happened in Ukraine and Russia has certainly clouded this picture, where I think, what is it, tonight or tomorrow, we will hear more from the Fed with regard to the pace of interest rates tightening. But I think we are at this juncture where it is a challenge that the Fed would need to balance the threat of rising inflation as well as slowing growth that might come through as a result of what happened. And I think Asia would see some spillover from this effect, and that's why the focus on quality companies that are able to pass on rising costs to the end customers has become even more important for us when we run our due diligence checks with the companies that we hold within the portfolio. So I think the pace of tightening might take a pause, but we got to see how that goes. And this really depends on how inflationary pressure and growth comes out as a result of the Ukraine/Russia war that we are in today. The third area would be about government support. And I think this is a continuation from the COVID support that we see the government from across the world putting through. Particularly, the case for China is quite interesting. And this is really because if we put things into context, over the last year and 2 years, China has actually been more about tightening, and it's whether you think about the tightening of regulations, tightening of monetary policies, and even on the property and e-commerce sector as well. But this year, I think the change came at the end of the year, where basically the government have put out a stance about stability being the central of focus now, and growth stability is something that they will continue to do. They will have to balance this though with the COVID resurgence that we are seeing in China today. And again, there is also a discussion as to how long will China maintain their zero COVID tolerance policy. That's something to be seen. But I think the disruption that we are seeing in as a result of COVID is causing some disruptions and a dampener on growth. So growth in China for the first quarter, whichever indicator that you look at, is going to look pretty weak. But that also means that the government would have the reason to step in to do a lot more. And I think the government has really indicated that they would be opportunistic in using fiscal and monetary policies to actually help to support growth, which they target to be around 5.5% this year. So that's something that we are seeing happening in China today. With regard to India, growth has been, I think, relatively elusive, and is an economy that is still continue to reopen from the impact of COVID last year. And we are seeing, I think for the first time in many years, a resurgence in the property sector within India, and the infrastructure cycle as well, which has been absent from India for the last 10 years. I think we are starting to see green shoots, and some of this is coming from the government's budget announcement, but also from, I think, the government intend to spend this as well in terms of execution. So we got to see how that pans through. But that, I think, the challenge for India would be on inflation, and also will be on how they manage the budget side of things, given that India is a big importer of oil, and energy prices are rising. So I think that's something that we've got to see how India manage it through. But so far, things seems to be stacking up pretty well. On the fourth topic of Capex growth, I won't spend too much time in this, but I think the key point here is that, we talk a lot about cyclical recovery, but actually the key thing to note here is the structural spending that is going on across Asia, whether you look at the spending in climate change. This would be with regard to the spending in renewables and electric vehicles, the spending in technology, a lot of this will be driven by the likes of what's happening in China to have higher self-sufficiency, but also by the likes of TSMC in Taiwan, which is expanding their manufacturing footprint to many parts of the world, including Europe as well as US, in addition to Taiwan. And we continue to see a strong Capex recovery cycle trend. But again, given where we are today, a lot of companies are starting to turn a bit more cautious from the latest set of results that we spoke to them. And I think they are just waiting to see how, again, the situation pans out in Europe. Just a quick word in terms of valuation today. This slide is obviously outdated given that so much has changed in terms of valuation over the past month or so. So just to give you an updated figure, the MSCI Asia ex Japan, which is the benchmark for Asia Dragon Trust, is now trading at 12 times price to earnings 2022. And this is below its 5 years long-term average of 14.5 times, and also below a one standard deviation long-term average as well. Forecast growth is about 13 to 14%, but I think this number in terms of growth might need to come down again, depending on the dynamism of the situation. You stack this up against the US, which is now post the market correction earlier part of the year, trading at about 19 times. Very near its 5 years average of 20 times, again with a single digit EPS growth that has room for downside. So the bottom line is that Asian equities do still look relatively attractive from a valuation perspective versus US counterpart, for example. And very quickly, I would like to end off with the last slide here that talks about the key investment themes that we have for Asia Dragon Trust. And even though we are bottom-up investors, we do think that these 6 key investment themes represent the best investment long-term structural growth opportunities in Asia. So the first one would be in terms of aspiration. So this is very much with regard to the growth of middle class. And people might fear that common prosperity would actually push this back in China, but I think again, the government has come out to clarify that they would like the pie to grow bigger, and the emphasis is on growing the pie bigger instead of dividing the pie up. So that means that the growth of middle class would continue to be spurred by China, but also in many parts of the world where demographics are looking attractive, such as Indonesia as well as India. Second theme would be in terms of building Asia, and this is where emerging Asia is featuring quite strongly. Again, this is about housing in India and cement company in India, for example. The third area will be digital future. This is where we have felt the biggest change given how our habits have changed during COVID as well. And in terms of how the market has changed, this used to be dominated very much by Chinese internet companies, but I think over the last 2 years, we are seeing very exciting opportunities in Indonesia, for example, where penetration of e-commerce has grown quite rapidly during COVID, and also in India, where some of these companies have started to come to the market, and we are getting long-term structural growth winners there as well. The fourth area is going green. I have talked about it just now, but the key change that you are seeing, which is driven by the recent development, is that, for example, the target for EU accumulated solar development has been pulled forward to 2030, and the target has been raised by 49%. This means that the increase in 9 years in terms of investment would be about 6 times, and that is beneficial for the overall solar market, where China is part of the global solution there as well. The fifth area would be health and wellness. Again, this is where it ties in very much to the growth of middle class, but also ties into the, I think, the under penetration and the lower spending of healthcare within Asia today that has a lot of room to grow. And the last bit would be tech enablers, and this would be the semiconductor companies, the technology companies that form the building blocks for digital future. So I'll take a pause here and pass this back to Pascal for Q&A.
2 seconds, guys. Just get my screen back on. Okay, thank you, Pruksa. We've got lots of questions, but not a huge amount of time, so I will try and be as quick as possible. Just looking at performance, it's been relatively weak versus peers in the same sector in recent years. Is that because of the trust's sort of value / quality sort of slant in a time when growth has been in the ascendant? And could you describe whether that's the case, and if so, whether that value slant will work in its favour in the current market and the future market you see?
Yes, I think it would be fair to say that our peers have a higher growth tilt than us, and hence, if you have seen how growth to value has been outperforming until very recently, that has benefited our peers that have a strong growth tilt to a large extent. We wouldn't classify ourselves as a value investor or growth investor because in our opinion, we are a quality investor, and you will see that we are actually overweight certain sectors that are actually quite expensive sectors. It's just that they have to be matched with long-term quality growth. So this could be markets like India, which trades at a premium to the rest of the market. And this could be in areas like information technology as well. And I think the other area is that what we have done over the course of last year is to use the volatility of the market and add a lot more in China A. And I think we have seen how even though our stock selection in China A has been positive and has been good, overall China as a whole has not been a favor of the month, well, of the year, in fact. And that I think has caused some of the difference in performance.
Thank you. From a completely kind of retail or somebody who's not very experienced point of view, why would you buy a fund like this and not buy a China fund and an Indian fund, given that obviously they are hugely dominant in the portfolio? Do the smaller holdings in other countries really make much difference to long-term returns?
I think they do, and I think if you look at our non-benchmark exposure to Vietnam, for example, that have contributed pretty strongly to the trust. And I think the reason why you would buy Asia Dragon Trust versus say a single country fund is that basically we diversify the risk for you from both a country perspective as well from a sector perspective, using the very same localized insights from the team that runs the All China Investment Trust, for example. So we have the depth, but in addition to that, we also have the breadth that help you to diversify your portfolio. So I think the key is that instead of you picking up your own how much weight you want to have in India, how much you want to have in China, we do the allocation for you.
Yeah. Looking at the kind of broader Asian region and some of the smaller countries in it, has the impact of COVID on tourism affected some of the countries with exposure to tourism as a sector? Countries like Thailand, where a lot of people go on their holidays. And do you see an opportunity for recovery here as the threat of the virus recedes?
Yes, taking Thailand as an example, and Thailand is where I'm from as well. So we really felt the impact of tourist arrivals, and this is important because tourism is a large part of GDP, but actually tourism also has a spillover effect and translates later on if you think about tourism plus in terms of the factor. So Thailand, we look at the lack of growth, I would say, has been in a very challenging time over the course of the last 2 years under COVID. And Thailand is reopening right now as we speak, and we are starting to see that coming back, but not in a big way. So I think as vaccination access improves, and I think that has improved a whole lot over the course of the last few months, many countries within Asia, including Thailand, will continue to reopen their borders, and we should see a return to tourism, and that would help fundamentally, some of the SMEs that are exposed to tourism, as well as the consumer spending power. So we're seeing this coming through, and that's why you will notice that we have initiated a Thai bank to leverage on this growth and potential improvement in fundamentals. And I think the market is recognizing that. That's why if you look at the strength of the Thai market, it is one of the stronger markets in Asia this year as well.
Super. Talking about food prices, and obviously it's becoming more and more clear that food prices are going up all over the world. will the positive momentum we're seeing in South Asian economies especially be derailed by rising food prices as they continue?
I think that will be a challenge. And the biggest challenge there has to do with India, for example, where food price is a very large part of the consumer price index. So there'll be some challenge from rising food prices from a spillover from the higher food prices globally. But I think what's more important is actually India's own production of certain crops as well. And a lot of that, as we have seen throughout the years, is weather dependent. So if you have a good monsoon in India, you do have good crops, and that means less pressure on CPI. And there's a lot of things about how actually distribution can be done a lot more efficiently so that you can reduce the wastage. So I think in times of rising food prices like this, then it comes back to India in terms of how they actually manage their own food security, as well as try to be more efficient in their overall supply chain. So maybe that will force the government to do a lot more on this front. But yes, it's going to be a growing challenge for many parts of Asia. Impact on this would depend from companies to companies, and we do analyze this at the bottom-up level.
Fantastic. Sticking with India, someone asked about sort of how your view of India and the opportunity there has changed. Obviously, when Modi arrives, which seems like a long time ago now, there was Modi mania and everyone was very happy. It was all great. And the country has come a long way, but there's also been a growing sense of, nationalism becoming a more powerful thing, and the BJP kind of becoming more, stricter in their interpretation of the rules and their treatment of their certain parts of the population. How do you feel about India against that backdrop? Are you still as optimistic about the outlook, or has your feelings changed?
I think within India, it's always a great bottom-up story with very, very well-run companies, and a disconnect with what's happening at the top with regard to the macro situation and the government. So if you have seen the overall long-term track record of Indian companies, for example, if you pick HDFC, which is one of the top names that we have, despite all the changes that you see in the government and the lack of execution, HDFC has a very strong execution from a company level, and that is really because India as a whole has come from such a low base that there is plenty of room for growth. So it's about picking the right quality companies to be able to ride through this. Politics have always been a challenge everywhere, and that's why within India, if you look at what we actually own within the portfolio, we have avoided the very politicized sectors. We avoided things that will be more prone to corruption, things that would be more susceptible and would leave because of the subsidies from the government, for example. So really back to the focus of companies, and our focus within India has not changed from a long-term structural growth perspective. If you look at what we like in India, it will be consumer companies. So companies like Hindustan Unilever, for example, that you would be very familiar with the products that they sell. And they have a very strong pyramid that are able to migrate the most bottom part of the pyramid to the top part in India. And this is going to be a multi-decade process with good brands, affordability, as well as good channel distribution, because they control the distribution that goes into rural India. So it will be companies like that, or it will be companies like homegrown HDFC that is basically very well run, very focused on providing housing mortgages, and this will again be driven by the penetration in India. So overall, I think India has its inefficiencies, and there are certainly things that we don't like, but I think they really have good quality of companies.
Fantastic. I'm afraid we don't have any more time for questions. If you want to learn more about India, our next speaker is Ashoka India Equity, and they come on at 11 o'clock. If you're not registered for that, you can just, if you're not registered for that, you can just tune in via the homepage of the website. You'll find full information about how to do that there. Meantime, thank you very much for all your questions. We have got a few that haven't been asked. I will send those to Pruksa, and we will come back to you with any answers we have. And thank you very much, Pruksa, for your time and a fascinating presentation.
Thank you very much.
Bye.
Bye.